Good morning. This is Greg Trotter. It's May 16th, 2024. And here we are going to learn some more today with the Commercial Building Consultants training program, if you will, of getting us all better and stronger in commercial real estate due diligence. We're a professional commercial real estate due diligence specialist group consultancy in Orlando. We've been doing this about a little over 20 years, and we kind of have a really interesting topic to discuss today. What I mean interesting is that I, for one, can say that I have made mistakes in 1031 exchanges, and it was by pure ignorance. So let's get rid of ignorance today and look to the expert. So we have Claudia here with us today. Kiernan, I've known another attorney named Kiernan. I'm not sure if you're related, but that's pretty cool. But anyways, Claudia is here from St. Augustine. That's too bad you have to live there. That is one of the greatest cities in the country, oldest and greatest family there. But anyway, this is going to be very informative on the nuances of 1031 exchange, and there are a lot of nuances, and you really need to work with a professional on these sorts of things. We're a professional on the physical side of commercial real estate due diligence and environmental and forensic engineering. But you got to look around and refer to others who know what you don't know. So without too much further ado, I will tell you that it's really important for you to stick with this. If you own a commercial real estate and you think, hey, someday I'm going to sell it, and I might use the opportunity to defer my tax gains in moving on to another property, drill down, learn from Claudia today, and we'll swing it over to her. I'm Greg Trotter with Commercial Due Diligence out of Orlando, Florida, and we're really pleased that you joined us. And Claudia, I'm going to turn it over to you because you're the expert, and I'm going to be sitting here learning just as much as everybody else. Thanks for attending, everybody.
Wonderful.
Greg Trotter.
Yeah. Oh, thank you, Greg. I appreciate that. I'm thrilled to be here today. I appreciate everyone taking time out of their busy schedules to learn about 1031 exchange or have a refresher. Before I get started, though, just want to let everyone know before we get into our discussion that the webinar is being recorded. Recording this session allows us to ensure that those who couldn't make it today can still benefit from the program. It also enables participants to revisit. So if you want to, after watching this today, you want to come back and look at it again, you can. But rest assured, your privacy is important to us. While the webinar is being recorded, your participation, questions, and comments will not be shared without your consent. So we aim to create a safe and engaging environment for everyone. So with that being said, who's excited to enter the fascinating world of taxes and the IRS, right? So yes, my name is Claudia Kiernan. I am a licensed attorney in New York and Florida. I'm also a senior vice president and regional manager with Investment Property Exchange Services. So we are what's known as a qualified intermediary for 1031 exchanges. When I was going to law school, I never thought that at the end of all that, I would be working with taxes and IRS and capital gains and all that. But it really is, I think from this webinar today, you'll realize it really is a fascinating section. It is considered one of the biggest wealth building tools that we have, and not only a wealth building tool for all of us on this call, but also it is a huge stimulus for our economy. Commercial real estate, by the way, is the #1 job creator in the U.S. So with an exchange, we're all being encouraged to reinvest in more real estate. So it really is a win-win. But again, the name of our company is Investment Property Exchange Services. We're commonly known, though, as IPX or IPX 1031. And so we're the ones that facilitate the 1031 exchange. We do all types of exchanges, from what's a forward, you sell, you purchase, or you can do a reverse, which we're doing 4 times the amount of reverses than we normally do. It's if you have to buy a property first, then sell. So we're a subsidiary of a very large publicly traded company known as Fidelity National Financial. They do title insurance. under the brand names Fidelity Title, Chicago Title. But I mention this only because this allows us to not only be the largest qualified intermediary in the US, but it also allows us to have the highest level of bonding and insurance in the industry. So what are we going to do this morning? So we're going to cover a good amount of information in a short period of time. I wanted to make sure that someone new to 1031 and that someone has experience in 1031 exchanges gets something out of the presentation. But first, we're going to, number one there, we're going to go over what is a 1031 exchange and what are the benefits of doing one. Again, 1031 has been part of the code for over 100 years. As Greg has mentioned, there's so many misconceptions in 1031 where, even in this office here in St. Augustine, we get calls sometimes where it's too late for someone to do an exchange. Maybe they've already closed on the property, and I'm going to go through the process of the 1031 and when it has to be set up, which is on or before the close. So we'll talk about those benefits and of the 1031, how it applies. We'll actually go through some scenarios. And then on number two there, you'll see we're going to walk through the exchange process, right? You might be familiar with some of these timelines, like the 45-day deadline, the 180-day deadline to close on a property, 45-day deadline to ID. How do you identify properties? And then what I call hot topics. The end of this call, you'll be like, oh my gosh, I don't know if Claudia has any life or what she considers a hot topic, and what you consider a hot topic is probably different. But anyway, are our reverse exchanges and vacation homes and second homes. Okay, so let's dive in. So the top paragraph in this screen is actually taken directly out of the Internal Revenue Code. And what it's basically saying is that a taxpayer, which is, by the way, what we're all referred to, any type of entity can do an exchange, meaning if the owner of the property is an individual, married couple, corporation, LLC, partnership, trust, they can all do a 1031 exchange. But what this allows them to do is sell that property, use a qualified intermediary, and we'll go through that process, reinvest, sell a property that's held for investment or business use, reinvest into another property that's held for investment or business use, and defer all the taxes that would ordinarily be due. So that's powerful, right? Because instead of writing that check to the IRS, they get to keep those funds and use the money to reinvest in more real estate. So again, when someone chooses to buy real property, especially commercial real estate, they're investing in the local economy, right? And the reason why it's been part of the code for 100 years or past Congress's scrutiny is because it is such a powerful economic stimulus. So it encourages reinvestment. You're going to see when we go through the presentation this morning how you have to reinvest very quickly into replacement property. But generally speaking, like-kind transactions or 1031 exchanges promote transactional activity. That results in jobs and taxable income that fuels other businesses, right? So powerful part of the Internal Revenue Code. So let's step back a little bit. What are sellers faced with when they're selling a property that's not their primary residence and then not going to do an exchange? Because it's kind of hard for me to talk about how great a 1031 exchange is if we don't know the other side of that. If we sell a property, what are we looking at in terms of taxes? So back in January 2013, two new taxes took effect, and sellers are facing higher federal tax and 3.8% tax that funds the Affordable Care Act. So we have long-term capital gains tax we see over there, right? And that's either 15 or 20%. Depending on your taxable income in a given year. So for example, if you're a single filer, if you're under 518 or 519,000 a year, you stay within that 15%. If you're a married couple and your income is over 584,000, around that, you'll have that 20%. So you could have like a threshold of 15 or percent. Then there's the additional 3.8% tax on investment income imposed by the ACA or the Healthcare Tax Act. And this happens when someone has an adjusted gross income in excess of 250,000 for a married couple or 200,000 for a single filer. So there's this additional 3.8% on this investment income. Investment income is typically, income from stocks or income from the gain on a property, right? So we'd have this additional 3.8%. And then, of course, why we love and improve property is that we can depreciate it, right? The straight line method, which is for commercial property, is 39 years, but of course we could accelerate that if we did a cost seg study. But what happens when we go to sell that property and we don't do a 1031 exchange? We owe some of that benefit back. We call that depreciation recapture, and typically that's at 25%. Lastly, state taxes, right? You're probably thinking, Claudia, why are you bringing up state taxes when we're in the state of Florida, which, as you see here, we do not have any state tax, right? But where are most of our clients coming from? I mean, our parent company, Fidelity National Financial, was originally a California company and then moved to Jacksonville, Florida, many, many years ago. But if we have someone selling in these other states, like California or New Jersey, pardon me, my allergies are bad, then they would also have to be faced with, if they're not doing an exchange, paying these state taxes as well. I always like to run the numbers, compare a sale versus an exchange. And what you'll see here, excuse me, is that up on this top box here, all of these taxes can be deferred in a 1031 exchange if we file the rules correctly. So we have long-term capital gains tax, just to recap, depreciation recapture, and then this net investment 3.8% tax. And we could also have state taxes. So let's say we're selling a property for $1 million. We fully depreciated it, and we're going to use a combined tax rate of 25%. Now, if I was doing this presentation in California, I might be using a 39%, right? Because we have all of these taxes here plus the state tax of 13.3. But let's imagine we're selling in Florida. We have a 25% combined tax rate. And if we have a fully depreciated property, we would be writing, if I was the exchanger, I'd be writing a check to the IRS for $250,000. Yikes. Never to earn another penny for me. So leaving me with after-tax dollars of $750,000. Let's compare it to the exchange over here. Anything stand out? Right? Zero's going to the IRS. I have the full amount to reinvest. And if I'm using if I'm going to have a 75% loan to value ratio on my replacement property, I can go out and get a $4 million property. So that's powerful, because if you think about it, that's one transaction. Most of our clients we're working with over the years, right, where they're buying and selling real estate and growing their real estate portfolio much faster than someone that's kind of just paying their taxes as they go. So seeing today with our clients and why they're doing a 1031 exchange, a lot of times it can be to generate cash flow. They may have properties that are just not giving them enough income monthly, or they have vacant land or a lot that they want to sell and replace it with a property that is giving them that income that they need. Thing that we're seeing somewhat often is these joint ownership problems. You can have properties that are owned together over here, and maybe they don't get along anymore and they want to get rid of that property or sell it and then maybe go their separate ways. Some properties just have a lot of management burdens and they want to get into something that's less management intensive. We have a lot of professionals that retire and sell, like an attorney that's selling their commercial building, and because they're retiring, well, they can exchange that property and they can do a 1031 exchange into any other type of real estate, which will cover, so that they don't have to pay all those taxes. The other is depreciation. Sometimes when we have a property for a while, and we fully depreciated it. Some of our clients want to sell that property, get into a higher valued piece of replacement property, right? Because they got to sell one and buy a new one to start taking depreciation again. The basis of the old property does move over into the new property, but if you buy up, right, sell for $1 million, buy for 2 million, we've just now increased our basis by $1 million and we can start depreciating. Lastly, on this slide, kind of trend we're seeing for quite a while is if someone wants to eventually get out of owning maybe that commercial property and they want to exchange over into a beautiful single family rental home that they're going to rent for a couple years and later on convert it over to a primary, especially people that want to retire in Florida. We see that. So in a 1031 exchange, we have a lot of our clients that use this diversification strategy. It's very common where they sell one property and replace with multiple properties. So let's just say we'll just use the same numbers to make it easy. Let's say they have a commercial property and they're selling it and it's worth $1 million. And they want to now use those funds to leverage themselves and get into multiple properties. So they could sell the one property. They could be located in different areas, anywhere within the United States. They could be different types of real estate. And they can go from owning this one property to owning 4 properties. So they could either put a certain amount down on each property or they could buy them all cash, whatever way to make it work. They would then now, instead of owning the one, own multiple properties. And it could increase their cash flow. From what I hear from my clients, sometimes the income that's coming out of that property that they own now is not as high as having these smaller valued properties. I also see a lot of transitions. I had a client recently over in the Tampa area sell 30 single family homes. And he took those single family homes, the proceeds from that, and we did an exchange into one large commercial property. It's a little bit stressful because once one of these properties sell, right, it does start the timelines, which we're going to go over shortly, the 45 and the 180-day deadlines. So he had to really have it so that they were all closing around the same time. Some of them he sold in groups to the same buyer. But what he was able to accomplish, and he did 3 tranches of this, 3 tranches of single family homes, selling them and getting into commercial replacement property. So this is what we call a consolidation strategy, right? We're going to consolidate down into one investment. Maybe it's something with less management intensive, or maybe it's a triple net property, so that they don't have to spend all their time managing it. Maybe they're getting close to retirement. Another reason for 1031, it's moving markets. I used to always, when I present, I always had the Midwest, New York, moving to Florida, right? Or moving their investment properties or commercial properties or relocating their business here. But now we have this other big trend of California to Florida. It makes sense, right? Because most of our clients that are doing this, they're really trying to get out from under the high taxes in California. So that's why you see this big trend of a lot of our clients selling in California, buying in the state of Florida, or maybe Texas or Tennessee or another 0 state tax state. So, we have times where a lot of our clients have a lot of equity in one property. And, they're also, as they get older, they start to think about estate planning, and so what they do while they're alive, they sell this one big commercial property. And for many reasons, that maybe they don't want to manage it now, or they're afraid if something happens to them, will their children be able to run this building or be able to sell it for the highest and best value? So they'll sell it and they'll replace it with multiple properties, with the idea of each of their children acquiring one of the pieces of property. This also helps if their children are not getting along. So they divide the estate among several children. They do this while they're alive. They sell, they buy. Our exchanger owns these properties. And with the idea of their children at a later date inheriting those properties. And the reason they're doing that is because they want to leave a legacy, but also they want to have the taxes go away, right? We have two ways that property can move ourselves to our children. It can be gifted. And the problem when we just give property to our heirs or to someone is that they receive the same basis that we have, right? Like, so let's say, for example, myself, I have that $1 million property. I have $100,000 basis. I give that property to my son. His basis is $100,000, right? And when he goes to sell it, he's got a $900,000 gain. However, if my son was to inherit the property from me, they get this stepped up in basis, right? And what that means is that 100,000 basis gets stepped up to the current value of the property of $1 million. So if my son now or shortly thereafter sells that property for $1 million, he's selling for $1 million. His basis is $1 million. He pays no tax. So it's a great advantage. My takeaway is this: is just that we have some clients that I've known for many years that their plan is to always 1031 exchange along into different types of real estate, possibly, maybe consolidate, maybe diversify, and with the idea of later on leaving that asset to their heirs so that their heirs could then get that step up in value. Um, Inheritance tax now, so because you think, well, okay, fine, they're going to inherit the property, but what about inheritance tax on an estate? And so I think right now for 2024, for an individual, it's if the estate is under 13.6 million, there's no inheritance tax. Married couples would be double that. So that would be 27, I think. Yeah, 27.22 or something. So for a married couple, so if their estate's under that. So this is a great planning tool for a lot of our clients where they can use the 1031 exchange, get it all set up so that their children can inherit properties, and then the children get that step up. All right, another big misconception for 1031 is, and I get this because the code section can be a little confusing. What it states is that the properties that you're exchanging, they must be like kind. So a lot of times people will think, I had a doctor that was retiring, he didn't want to sell his commercial building because he thought, well, if I sell this commercial building, I've owned it for over 40 years, it's fully depreciated, I'm going to get hit in taxes. So I'm going to hang on to it. I will rent it out and I will have my children inherit it. But he didn't really want to keep this property. He wanted to get into some other types of investment, maybe another commercial type of property that was, something easier to manage and a higher income, cash flow coming from it. So when I explained to him that no, you don't have to, he actually thought that, and I get it, that if he sold a medical building, he'd have to buy a commercial property used for a medical facility of some sort. So that's not the case. If you see on the screen here, all of these things that are listed on here are all like kind to each other. Real property is intrinsically like kind to real property. So what they mean by it is that the like kind is how we're treating it. Is the property that we're selling and buying or exchanging held for investment or business use? That's what makes it like kind. So I could go from an industrial property, right? And I could even buy a single family home as long as I'm renting it for the first 24 months. Or I can sell a rental home and now get into commercial property. So as long as they are treated as investment or business use, that all works. So the other, one thing I just want to bring up here about DSTs and REITs, because this is a question I get all the time. Some of my clients, when they call us and I'm going over how the 1031 exchange work, they ask me if it's their first exchange, can I get into a REIT, a real estate investment trust? And unfortunately, the REIT would not be like kind because you're getting shares and stocks, which is not considered real estate. But I just want to illustrate that there are similar types of products out there where someone could buy into, like this Delaware Statutory Trust. And basically, it's a trust that owns title to the property, and the 1031 investors go in as a beneficial interest of that trust. And then there's also what's referred to as an UPREIT. So they have those kind of products out there. What doesn't qualify for a 1031 exchange? Uh, Properties that are being flipped, meaning that someone's buying the property, fixing it up and selling it. That wouldn't work. That's property held for resale. We're up here, right? Held primarily for sale or resale would be like someone flipping a property. But let's look up over here on top. It's kind of small. I apologize. The stock in trade or other property. So if I'm a dealer, a developer, or I'm a house builder and I'm building houses and I'm selling that, that is really considered inventory property. It doesn't qualify for 1031 exchange. So that wouldn't work for 1031. Question I get often is, well, Claudia, I'm selling this property. I want to take the proceeds and pay down a note on another property that I own, another, maybe a commercial property or a residential rental property. That doesn't work either, right? The whole idea of an exchange, it's a continuation of the old investment. We are relinquishing and acquiring something new. It's a new piece and it has to be real property. So buying a note doesn't work for 1031 purposes. The other one that doesn't work or it doesn't qualify is this primary residence. Now, we can change our intent in how we own properties. I have a lot of exchangers with us that maybe property was their primary residence many years ago, and now the last use is rental, and they want to sell that and move over to some commercial types of property. That's fine, right? Because we look at the last use of the property. But what we can't do is, let's say that doctor that's selling that commercial property in that example, he can go out and buy a single family property, but initially it has to be like a single family home, but it must be a rental property the first 24 months. What he can't do is sell that medical building and buy the single family home and move into it the next day. That's not like kind. Primary residences or even a second home, a pure second home, is considered personal use property. It's not considered held for investment or business use. Even though for some of us it might be our biggest investment, it's considered personal use. So, but there is that way to sell investment property, buy investment property, and then like a single family rental home, you would want to rent it for 2 years. Then you could convert it over to primary. So if anyone was looking for an exit strategy of not being a landlord, or maybe they're retiring out of a commercial property that they had their business in, they could replace it with a single family home and then rent it for 2 years, though, 24 months after acquiring it. Then you can convert it over to the primary residence. We have, I spend a lot of my time on conference calls with clients that have properties owned in a partnership or in a multi-member LLC. And sometimes this can be tricky because in this drawing there, you'll see there's two partners. Sometimes as time goes on, the partnership doesn't really work as well anymore because maybe we just have different goals. And one of the things that comes up, if you have property that's owned in a multi-member LLC and you have multiple members, one of the things you can't do is the members themselves can't do an exchange. It's always on the partnership or the multi-member LLC level that would have to do the 1031. If that's a situation that you have, please call me and I can discuss possible solutions in that, in terms of making it so that you can do a 1031 exchange. But it's definitely something we have to discuss before a closing, right? Because it's only the taxpayer that owns the property that can do the exchange. So whoever the title holder is, that is what we call our exchanger. They're the ones that are selling, they have to do the exchange, and they also have to be the one that's purchasing in a 1031 exchange. Okay, get this call lately. Oh, Claudia, I'd love to do a 1031 exchange and I'm selling in Florida and I'd like to buy in Spain. In a 1031 exchange, U.S. property has to be exchanged with U.S. property. Kind of makes sense, right? When we think about why 1031 is allowed, it's because it's an economic stimulus is one of the big benefits, right? We want to stimulate our own economy. The other reason I think possible is that, if someone sells in the US and they exchange for a property in Spain and they sell it later, it's kind of hard for the IRS to track, right? Because it is a tax deferral strategy. You know, if we 1031 exchange along and eventually we sell that property, that's when we would have to pay that tax. So U.S. property for U.S. property, which U.S. property includes, in certain circumstances, U.S. Virgin Islands, Guam, Mariana Islands. Unfortunately, it doesn't include Puerto Rico. So now you can do an exchange of foreign property. I had someone call me last week about a property they're selling in Sydney, Australia. They did want to sell in Sydney. They were U.S. residents, had this property in Sydney, and they wanted to sell that and buy in the U.S. Unfortunately, again, foreign property and U.S. property is not like kind. But what they could do is if they wanted to sell in Sydney and then buy in England, they could do that. Foreign property is like kind to foreign property, but foreign property is not like kind to U.S. property. Okay, timelines. These are super important. As I said, one of the things that happens, and it was again earlier this week, I'm not sure what day it was, doesn't really matter, but it was a call from a gentleman. It's terrible to break this news to them, but when they call and they say, oh, you know, I got your number from so-and-so, and I sold a property and I want to do a 1031 exchange. I have a contract on the replacement property. So then I had to ask, well, when you say sold, do you mean a contract, a signed contract, or did you close on it? And this gentleman did close on the property the week before. And, you know, he was told that, you know, he had, or maybe misunderstood, but that he had 45 days from the closing to get the exchange set up, but not the case. Very key requirement for 1031 is that before the closing of the sale property, which we call the relinquished property, they have to have the exchange set up. We've even done it where we've gotten calls from title companies or attorneys' offices saying, hey, I have someone here, or it's closing today. They want to do a 1031. We can do it, right? Because the reason is that in a 1031 exchange, the qualified intermediary is kind of pivotal to the settlement, because what we're doing is creating an exchange agreement. So that sets the nexus between what they're selling and what they're buying, that is executed by the qualified intermediary and the seller in this transaction on this side of it. And then we are assigning into the sale contract, meaning we are stepping in the shoes of the seller. So we're assigning into their rights. So part of that settlement or closing, we're the seller, and that's why the funds are coming to us. The big difference you'll see if you've never done an exchange before is that once the closing costs are paid, so that's all paid out, and that'll include real estate commissions, you know, title insurance premiums, surveys, doc stamps, and any kind of mortgages are paid off. The net proceeds, once that is all completed, must be wired to the qualified intermediary. It can't go to the seller. And so that caller, not only did he not have the qualified intermediary set up and the documents signed, but he also received the funds. So that disallows the exchange. So that was unfortunate. So we got to get the exchange set up on and before the closing. Now that closing is considered day zero. The exchanger, anyone that's doing the 1031, we call the exchanger, or a client, has 45 calendar days to identify what they're going to purchase. So on or before the 45th day, and their calendar days, meaning if the 45th day falls on a Sunday, they don't have till the following Monday like we do with our tax return. So they have to identify properties to us on or before the 45th day. Now, once we get past this 45th day, we cannot change what has been identified. And I'm going to go over what it means to identify property. But once we get past that 45-day timeline deadline, we're stuck with what has been identified. So we've got to purchase something on that list. We can identify more than one property. And then we have 180 days to close. That normally isn't too much of a problem for residential properties. On our commercial side, it can be, right? As you all know, when you're buying commercial property, there may be a long diligence time period. If something's being constructed, like a warehouse or any type of real estate, we want to make sure that our client can close at the 180th by the, on or before the 180 day. It can't go past that. So it can be very stressful. A lot of times on our larger or medium, like commercial transactions, a lot of this is being done, meaning the sale contract and the purchase contract, even before the relinquished property closes. So sometimes from a lot of our repeat clients, they'll send over the sale contract and the replacement property contract even before their sale property closes. But yeah, if whatever you can do before the closing of the sale to get your replacement property going really helps and gives you some more time there. We have to be careful, by the way, at the end of the year, because what's interesting about a 1031, or again, to me, what's interesting is, let's say you have a situation at the end of this year where you're closing a property, and let's say it's December 15th, right? And now your 180 days is going to go to June 15th, but your taxes are due April 15th. If you have not purchased your replacement property yet, you can't file a return for the previous year. So let's say you close December 15th, 2024, you get to April 15th and you haven't purchased your replacement property yet, then you can't file your return for 2024. You have to file an extension because it will cut off this 180 days if we file that return. So we kind of treat all of our exchangers from approximately October 18th to the end of the year differently, where we're constantly reminding them that if you do not identify anything, I mean, if you don't close on something before you file your tax return, you have to file an extension. We do, so we don't, I just said that, we don't have any extensions for the 45 and the 180-day deadline. We do sometimes have these disaster extensions. Unfortunately, they're more frequent than what I've had experience before previously. But last year we had a couple for hurricanes. But it's not our own personal disaster or bad inspection. What happens with these is, this is a snapshot of the IRS website. And so they will put relief on for affected taxpayers. And if our client happens to be an affected taxpayer, and depending on when it happens during their exchange, they can get extensions to possibly to both the 45-day deadline and the 180-day deadline. Okay, so how many properties can we identify in a 1031 exchange? So we have to use one of these rules or this 95% exception. So the list just can't be endless. The rule that's used most often is this 3 property rule on the left-hand side of the screen. And that was a simple one. Client or exchanger can identify 3 properties of any value. But let's say the strategy is to diversify and to buy more properties than 3. Well, then we can use this 200% rule. So they're either or. We don't want to combine them. And clients sometimes that combine the 2 rules. You can either use a 3 property, each property can be any value, or we can use the 200% rule, which states you can identify any number of properties. However, the properties you identify cannot add up to more than double of what you sold for. So our example was that $1 million sale. If we want to identify, I don't know, 5 properties, anything over 3, 5 properties, they can't add up to more than $2 million. So let's say I'm the exchanger, identify 5 properties, can't use the 3 property rule. My properties that I identify are more than 2 million. Yikes. Well, now I have one other possibility, which is this 95% exception to the right of the screen or the slide. If the exchanger identifies properties in excess of rule 1 and 2, right, which is what I've done, then the exchanger must acquire at least 95% of the value of all the properties identified. So basically, you need to buy all of the properties that were identified to make this work, unless you had very small priced properties, which doesn't really happen. We used to, before the Tax Cut and Job Act, we did exchanges of many different types of property, like real estate was one of them, of course. but we also did like equipment or medical equipment or construction equipment. We did franchises. Like if some of you on this call have a commercial property, but you also have a franchise, you could exchange a franchise for a franchise. So, and we could do automobiles, and we did a lot of exchanges for large manufacturers that you're very familiar with automobiles, when they lease them and they get them back, and then they depreciated them, and then there's a gain when they sell them. The 95% will work then, but we still have it for real estate, even though we cannot do those types of exchanges anymore. And so really, though, for real property, it would have to most likely be that you have to purchase everything you identified. How do we identify? So what has to happen by midnight of the 45th day, our exchanger needs to send us, and we create a form for them to do it, an identification form, which unambiguously describes the property. So, we're looking at these IDs, and so want to make sure that if someone is identifying land and an address doesn't do it, they need to put the legal description or parcel numbers. I had this call with a client where they were listing 3 properties. So 2 of them were easy. They had legal description for both. The third one, there's no survey yet, and they're coming up to the 45th day. And so they didn't have a survey to give me. They didn't have a description. They were trying to say, well, it's the corner of this state road and another road. Well, that doesn't work, because which corner? It was like the identification came over like 13.66 acres, more or less, on the corner of these 2 roads. So I explained to them, no, it's not site specific. You have to be able to point to it. So the last thing, and I have to go, we'll see where they're at with that, is like, what about a map, right, where you're drawing it out? So the other thing where it comes up is if someone's looking at, let's say they're buying a commercial unit, like maybe an office condo, and it's a new build. And so they're not sure which one they want to buy. There's a lot of them, right? So they're like, I want, it's more than 3 that they want to list. So they figure out, I'll just put the address of this strip center. Well, that means you're buying the strip center, right? So you have to put the unit number in. Now, within the 45 days, they can revoke an identification and re-identify. After the 45th day, they're stuck with that property. Whenever anyone's doing an exchange for the first time, especially, I mean, I go over this all the time, but if they've never done a 1031 before, I really kind of drill down on what we call these equal or greater rules. And basically for 1031, if you want to be fully deferred, let's say you're selling a property, again, for $1 million, and maybe you bought it for $500,000. So you have a $500,000 profit in the property. So if you sold the property and didn't do an exchange, you're only paying tax on the $500,000, not on your investment in it, the money you bought it for the $500,000. So just the profit. So many times, and rightfully, I get this, I would think the same thing, is that a lot of our new clients that have never done 1031 before think that they only have to reinvest the profit, the $500,000, because that's what they'd be taxed on. But a 1031 doesn't work that way. It's really a continuation of the old investment. That tax basis, which generally speaking is what you bought the property for, plus capital improvements, minus any depreciation taken when it's going up and down, is going to move over into the replacement property. And then, so at the end of the day, you got to do these 4 things to be fully deferred. We can go off of that and have what we call a partial exchange and pay some tax and defer some tax. But let's just look at a clean 1031 where we don't have to pay any taxes, which is a lot of our goal, right? To not pay any tax. We're going to, number 1, buy a property that's equal or greater value to what we sold for, minus closing costs. 2, reinvest all of the net proceeds from the sale. 3, a lot of times the properties that are being sold have financing on them or a mortgage. If there was a mortgage that was paid off at closing, we got to replace that mortgage. And then 4, receive no money. Don't put any money in your pocket and you'll be fully deferred. Now there's confusion over number 3. A lot of times I get a call where someone will say, well, I had a mortgage on my sale property. I got to have the same exact amount and mortgage on the replacement property. Not correct, right? They can do that, but they just need to replace it. The IRS or Congress is not requiring us to go out and get a loan. They're just requiring us to buy for equal or greater value. So we're just you through a scenario. Property selling for $1 million, let's say 50,000 of closing costs. So now we're at 950. So we got to purchase the property for 950. At closing, the closing costs were paid, the mortgage was paid off. So as a qualified intermediary, we receive a wire for $450,000. So now our client has to go out and buy a property for 950. Well, we only have 450,000. So they got to make up that mortgage that was paid off, which, by the way, when it is paid off, it's referred to as mortgage boot. Anything in a 1031 that's taxable is referred to as boot. So it's mortgage boot because the mortgage is paid off and it's taxable. But all we have to do to have that not be taxable is replace it. So we wire out the 450 for the purchase of the 950 property. Our client can either get another loan, they can add cash, they could do a combination of both, right? So if you just do two things, it'll always work out in my mind. Buy for equal or greater value and don't put any cash in your pocket, then from a math standpoint, it's going to work. Because you got to get up to the 950, and if we only have 450, you're going to have to come up with the difference. Okay, just real quick on this. This is that conversion, just because it comes up so much, I just wanted to touch on it, where someone sells a commercial property or a rental property. They do a 1031 exchange into their beautiful home, rent it out for 2 years, and then after 2 years, they could change it to their primary residence. And the question, and if any of you are looking for that exit strategy later on, you could do that. When you convert it over to primary residence, there's no taxes due at that time because you're not selling it. Now, when you do sell it later on, you would have tax. You would always have to pay recapture on depreciation on it. And then you'd get a proration share of the primary residence exclusion. I don't know if you guys are familiar with that, but if you live in a property 2 out of the past 5 years, all gain up to 250 is tax-free. Married couples, 500,000. Acquiring a property through a 1031, though, you got to own it for 5. And then now the primary residence exclusion has been modified. We don't get the full amount when the initial use is anything but not qualified use. But if anyone has any questions on that, please give me a call. I'm happy to go over it in more detail. We can have, if you own a multifamily property and you happen to live in one of the units and you're selling it, you still can do an exchange, even though primary residences don't qualify. We're just going to carve out that primary residence portion. So in this is an easy example. That's for me. That, let's say it's a fourplex and our client lives in one unit. We can do an exchange on these 3 units and 1031 those into another property that is held for investment or business use. And then our client takes the funds, the proportionate, that they would, this is an easy example because all these units in my example are exactly the same. So if it's selling for $1 million, our seller client would be getting 250,000. IPX would be receiving 750,000. So we would be taking the 750 and they would be going out and finding another property that's held for investment or business use. So commercial property, residential rental. And if they wanted, they could do this again, but they just got to make sure and realize that any part of the replacement property they're using for personal use, like a primary again, would not qualify for 1031. So just coming up to some last little, so I want to leave some time for Q&A. Some example or requirements in 1031. This is one of our basic 1031 rules. It's very important. Is that when someone does an exchange, either that be that an individual like you see here on the screen, or a partnership, multi-member LLC, or corporation, or trust, whomever that is, they also have to own the replacement property, right? So we call this the same taxpayer requirement. They sell, they have to purchase. There are some exceptions to how we title it, because we can have title holders that are not taxpayers. So for example, I could sell in my individual name. Let's say I own a commercial property and it's in my individual name. And now I'm going to sell that, and it's set up in Claudia Kiernan as the exchanger. Now Claudia has to go out and buy the new property, but I have some options. I can title the new property in a single member LLC, right? And as long as I'm the sole member and it's a disregarded entity for federal tax purposes, that's fine. So I could sell as Claudia, acquire my new property in an LLC, as long as it's a single member LLC and I'm the sole member and it's disregarded for federal tax purposes, totally fine. I can't add my husband to that LLC, right? Because now I've created a partnership, which is a different taxpayer. I could do that if I was living in a community property state, by the way, but I'm not. I'm in Florida. The other is trusts. Like sometimes we have land trusts. If any of you have properties held in land trusts, because you don't want, you're hiding the ownership of the property for, liability protection. Let Florida land trusts or Illinois land trusts. I could sell in my individual name, and I could acquire in a land trust as long as I'm the beneficiary, or a revocable living trust if I'm doing some estate planning. So part of the exchange, what we're doing, we're acting as the principal, like I was mentioning to you earlier, where we step in the shoes of our exchanger. We act as the seller of the sale property and the buyer of the replacement property. We're holding all the funds. The funds are coming over to us. We're preparing all the legal documentation, and we're guiding our client throughout the exchange. Just want to touch on this so you know that you have this ability if this comes up. What I've been discussing so far is the forward exchange. You can never own both properties at the same time, right? You're going to sell or close on the one that you own now. Money's going to come over to the QI, and then we're going to purchase. So we're exchanging. You're getting rid of one and purchasing another. You may have a situation if you're a business owner, and you have a property, you have a commercial location, and you're thinking to yourself, wow, I'm growing. This location doesn't work for me anymore. I want to exchange it into a bigger location. Well, a lot of times you can't have that stop, right? You got to get your employees over to the new property. Or it could just be you find the perfect replacement property and the seller's like, look, I'm not waiting for you to sell the other property. Well, we can do what's called a reverse exchange, right? Just give me a call and I can go over that with you in terms of how it works. But basically, we're parking the property in a newly created LLC for you. And when your relinquished property closes, you're going to acquire that property from us. So that's available. The build to suit exchange, let's say you sell a property, we'll use the $1 million sale. You find a perfect property for 700,000. And however, it needs a lot of improvements. You need a build out. It's got to be retrofitted for whatever business is going in there. Then we could do a build to suit exchange. Same kind of, we're working from the same revenue procedure where we're going to go on title to the property. You'll request draws from us. They have to go out to the contractor. Keep in mind, this is kind of a little bit challenging or stressful, this build to suit, because those improvements got to get done in 180 days, right? Remember the 45 and 180, you sell, the money comes to us, we park the new property, and then you're going to be requesting draws. But those improvements that you want to do, if you want to get credit for them to bring the 700 value up, they got to be done within the 180 days and before you own the property. So you got to kind of work fast on that one. Just some security questions to ask you. Our parent company, Fidelity, created us in 1988 really to provide a safe, secure 1031 option for all of their agents. So they created us with having the highest level of bonding and insurance in the industry, but what to look for with a 1031 company, because all that it is required to be a qualified intermediary is that you're not disqualified. Meaning that the qualified intermediary didn't do any work for you in the last 2 years. There's no requirement for bonding insurance or segregated separate accounts, or that you're an attorney, or that you have a separate division for banking. So you want to make sure they have very high levels of insurance for Fidelity bonds. We're publicly traded, so that makes it easier because, it's better because everything's transparent. As an attorney, I would say this is super important, that the funds, when someone's funds comes over to us, we set up a segregated, separate interest-bearing account, and our client is filling out a W-9 for the bank. And then Fidelity approves the bank. So which banks are they going into? You wouldn't think we'd have to think about that now, but it's important. So Fidelity vets the banks that we're using, that you're very familiar with, the large, highly rated banks. And then the account requires dual signatures, our clients and ours, to authorize any kind of disbursement out of that account. Our website has some great materials on it as well. There's webinars, there's newsletters. But we don't charge for any kind of consultation or time. So if you have any questions, you want to go over everything. In terms of fees, if you want to get an idea of that, our forward exchanges where you're selling and buying, it's typically just a flat fee of around $1,200. It's not something you pay up front. It's an allowable expense from the sale proceeds when we receive them. Reverses and built to suit exchanges, those can be more expensive. They generally start around 6,000 and can go up. And the reason for that is we're on title. We have to give you a triple net lease to operate the property, and there's a promissory note, and so on and so forth. But this is all my contact information. I did want to leave enough time for any questions or see if there were any in the chat.
Well, I can tell you, Claudia, that I certainly have learned a lot, and multiple aspects that I had no clue that you could do with, for example, inheritance, long-term portfolio planning, that never even came to mind, let alone knew that it was out there. This has been more than I ever expected, and I knew it was going to be interesting. But didn't I tell the audience that it's going to blow you away with a lot of information? We certainly thank you for that. Is there anyone else that has anything to add?
Claudia, I think Amanda is on chat.
Oh, okay, great. Thank you.
Her question was, what if you're 1031 into a duplex and live in half while you rent the other side for 24 months?
Yeah, that's perfect. It's just that the portion and that duplex, the portion of the duplex that you're living in, you can't do the exchange. But the other side, absolutely. We have those a lot. So when we do the exchange, let's say you were going to sell that duplex, we would just be identifying the sale property as Unit B if you lived in Unit A. Or if you were going to purchase a duplex, then you just have to be careful that the exchange money is only going towards Unit B, the one that's being rented, not the personal use property side of it, which would be Unit A.
Hi, I think I unmuted myself. This is Amanda.
Hi, Amanda.
There she is.
Yeah. So if we have a client that's selling one property and wants to purchase two properties, but one of the properties isn't up to standards, and would like to have some renovations done on it, is that what you're saying, that has to be completed within that time frame? It can't be completed after closing?
Right. Yeah. No, because improvements that are done after they own the property are not like kind. So the mechanism is, so let's say they're going to buy two. The first one they can close on that they don't want to do improvements. The second one that they want to get the improvements included, we would set up an LLC and go on title temporarily to the property. We're known as an exchange accommodation title holder. And then your client would be requesting draws from us that would go to the, contractor. And then they'd have those improvements done that they want to get credit for. They don't have to complete the project, but whatever improvements are done by the 180th day, they would get credit for. But yes, they would unfortunately have to get it done by the 180th day.
Okay, fantastic. So that's basically what we did. I just wanted to see if that was standard practice. Okay.
Yeah.
Question with that, Claudia, is what if Amanda's property was still, as long as it was occupiable and her improvements were enhancements, would that be a free flow of 1031? In other words, Amanda was able to do the work, but it was more, it wasn't electrical, it wasn't an addition, but rather just something cosmetic and enhancement. Then that would go free and clear, would it not?
Right. It's only when you want to use the exchange money for significant capital improvements and you want to raise that purchase price up.
But not CapEx as far as repaving the parking lot, but actually replacing the roof, or define?
Oh, it could be many things. It could be building a building, a warehouse. Okay. It could be a roof. It could be, anything that's capitalized. It could be, yeah.
Great question, Amanda.
Yes, very good.
I guess what I was intrigued by is the concept of, you have one building and you sell it and you buy four, and then you could put them in various different scenarios on an inheritance basis. I mean, you just went in places. I got to tell you, Claudia, you went in different places I'd never even considered.
Yeah.
And this has been really helpful.
Oh,
Yeah.
good. Yeah, you could put, if you think about it with the trust, you could do a revocable living trust, and then each of your children could inherit one property separately, right? A lot of my clients, they'll buy something that the children could start managing, right? So yeah, it's a great strategy for that.
I guess. Well, you have been a lot of help. Anyone else
Oh,
out there?
thank you.
Can I just ask one last question? This is Amanda.
Absolutely.
You
Hi.
stated that they could purchase an investment property as long as it was rented a single family for 1 year, and then they could occupy it as a residence?
No, 24 months. It should be
24.
24 months. There's a revenue procedure. That is, I mean, they could do it after a year, but we have a revenue procedure that was issued in 2008. And in our world, we all feel that you should wait that 24 months before you would be moving into it, converting it to primary. That would be the more conservative approach.
Thank you.
Yeah. It's a great strategy, though, for someone that, wants to exit and retire and, get into something that, that they can enjoy.
Yeah.
Yes.
Some of us are at that point. Good
Yeah.
job. We like representation from the old people. Yeah.
And if anybody has any other questions and they would like to contact Claudia afterwards, her information is up on the screen right now, or you can contact our office and we can get you in touch with Claudia as well.
Yeah,
Well, thanks.
absolutely. Feel free to call me. I mean, I spend most of my time, on the phone with people like yourself. So.
Well, I'm going to tell you, I have a couple of questions. I got to catch up with you in the next
Okay.
week or so again. So I look forward to that, and thank you very much.
Okay, thank you all. I appreciate your time. Thank you for joining us.
You're
Thank you,
welcome.
Claudia.
Bye-bye.
We appreciate it.
Okay, bye-bye.
Bye.